This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. Bit of a long episode today, just Cameron and I chatting too, so sorry about the length.
Yeah, we debate on the length, and sometimes I feel bad we go too long. I don't know.
I always say to you, Cameron, though, that we've never once gotten the feedback that the episodes are too long.
Now, if you have that feedback, we would love to hear it. Because we don't have the data, we'd love to know. Some people say it should be the length of the average commute, which, I don't know, 20 to 40 minutes, depending where you live.
Split a long episode up between two commutes.
You talk to people in New York, they say, well, I spent an hour and a half on the train, so we love the length. I don't know.
Anyway, so the episode's long. We'll keep the intro short, but that's it. We hope you enjoyed it.
Today was a lot of risk talked about today. So it's long and about risk. So take as you will. So anyways, have a listen.
Welcome to episode 68 of the Rational Reminder Podcast. We switched out one of our current topics that we usually go through for a couple of listener questions. We've had some really good listener questions.
Love getting them.
Yeah.
And best place to do that is on the comments, I guess, on the Rational Reminder website.
Yeah, I'd prefer that because then other people can see them, but these ones actually came through by email, which is also fine.
Cool.
So should we jump into the questions?
Sure. Question 1. So when deciding asset allocation in a portfolio, the equity bond ratio is often discussed as the variable to adjust for risk tolerance. If an investor has decided on an 80-20 ratio, so 80 stocks, 20 bonds, should they reconsider this ratio if they start tilting based on factors?
Yeah, it's a great question. And actually, this wasn't in my notes to talk about, but I just realized it's interesting. I just finished writing a new paper on asset location, which is going to come out hopefully in the next few weeks. But I found an academic paper that looks at asset location from, instead of controlling for the mix between stocks and bonds to optimize asset location, they control for utility, which is not the easiest term to understand in the context of asset location. But it's similar in what we're talking about with the factors. It's like if you have a target mix between stocks and bonds, if you start substituting in stocks with different risk return characteristics, maybe just the equity bond mix doesn't actually make sense. Maybe you should be targeting a level of utility, but how do you measure that?
So you talk about utility, which is unit of return per unit of risk, perhaps. Or like, what do you want to control for, risk or return?
Yeah, that's kind of the question, I think. Anyway, so the question is a good one. But when you start adding in factors, yes, it does change the risk return characteristics of the equity portion of your portfolio. Now, within the question that this listener asked, I think that they were thinking from the perspective of, by adding in factors, you're making your equities riskier.
For sure, that's what they meant.
Yeah, and that's not what's happening.
And am I taking on more risk than I should be?
Exactly.
Unexpected risk, but that's not what happens when you melt these all together inside a portfolio.
I've had this question asked different ways on a bunch of different occasions, but just because the factors like adding in additional small cap or value, just because they're independent risks, because they're independent risks, you're not increasing the absolute level of risk in your portfolio.
Because they behave differently at the same time as other factors.
That's right.
And it's this combination combined with rebalancing as they do move around that smoothens the ride, reduces volatility, but increases expected return.
Exactly. I mean, it's kind of like saying, if I add an international stocks to my Canadian equity portfolio, is that increasing my absolute level of risk? No, you're adding in additional risky assets, but that's not making the portfolio riskier. It's making it safer.
Yeah, and you can actually build your portfolio to target a level of volatility and then take as little equity exposure as possible.
Yeah.
Right? So go the other way.
So this is kind of that target utility discussion that we were talking about, or a target risk return, as opposed to just why would you focus on the mix between stocks and bonds when you can add in riskier stocks to get the same risk return characteristics with less overall equity exposure?
And I can remember Larry Swedrow many years ago when he presented to clients of ours talking about how he had chosen to get the maximum amount in fixed income given a return profile he wanted. So he actually barbelled the portfolio with I think it was 60% bonds on one side and 40% equities, but it was only factors on the equity side.
Small cap value, I think.
Small cap value.
So you load up on some small value with the higher risk adjusted returns, reduce your overall equity exposure. I wouldn't do it though.
But then the risk is how are you going to behave, because you are going to have massive tracking error.
Massive tracking error.
And you have to be committed. Now he could pull it off. He knows what he's doing.
Yeah. And a big bet on small value is, that's scary too. Like, we don't do all small cap value portfolios. even if that would be rational, because of the two things we just talked about, because of the tracking error and because going all in on one factor is scary.
Yep.
I guess that's going all in on a couple factors if you're small value.
Well, that's just it, right? This is an extreme situation. And if you went all equity just in small value, forgetting bonds, that would be...
It's tricky too, thinking about like when you target a factor exposure in terms of the regression coefficients, if you go all small value, you're going to have strong exposure to small and value, or the size and value factors, size and relative price. But market-wide value and small value can have materially different performance characteristics over a given period of time. So even though you might have strong regression coefficient exposure, like from that perspective, by going all small cap value, you're still missing out on the potentially high returns of market-wide value by doing that.
Exactly.
So that's one of the other risks. Anyway, so to answer the question, sure, if you start adding in factors, it might affect the risk profile of equities. And maybe there is some consideration for changing your mix between stocks and bonds from that perspective, but it's not super easy to think about.
Right. But if you have a strategic allocation to these factors and stick to the rules and rebalance, higher expected return, lower expected volatility. Question number 2. I am slowly making the shift to index investing, but I have a concentrated portfolio of individual stocks with significant capital gains. Is there a rational reason to keep the individual stocks long-term to avoid realizing those gains?
Yeah. So, it's a tax question. In this situation, the securities were sort of gifted throughout early adult life by a parent. So there's like really big capital gains in the portfolio. Obviously, selling any position is going to result in a big capital gain.
But is it a tax question, given the idiosyncratic risk of individual securities?
You're right.
You can wipe out that gain in no time for something completely unforeseen.
You're right. It's not just a tax question.
And again, we'll go back in time, but I remember talking to people that had Nortel shares at over $120 a share. And oh my God, I can't sell because the tax is going to kill me. It's like, well, the implosion of the stock pretty much made that debate moot. We used to show people, if it goes to $90, your whole tax, and I know we're going back in history, but it's a great illustration. If the stock price drops to $90, your tax debate is moot. And is there a chance of this stock going to $90?
Well, we know how that
played out. But at the time, but it could go to 150. Yeah, well, we know how it played out.
Yes, it could.
So yes, it is taxed. And yes, you could end up, depending on your age, getting into OAS clawback and whatnot. But boy, the idiosyncratic risk can wipe out that tax debate so fast.
Yeah. I think thinking about the tax cost, you can't just think about what is today's tax bill going to look like, because you've also got to think about, so this is just on the tax perspective of this question, you're going to pay an absolute amount of tax in the year that you sell, if you sell these individual securities and incur the big capital gain. But you can't just look at that number and evaluating what is the tax impact, because you would have paid that tax in the future. So you're really looking at what is the difference between the present value of paying this tax in the future and the cost of paying it today. That difference is kind of the hit you're taking.
Plus the compounding, I guess, on that money that would have been paid in tax.
Well, that's
still the investor, right?
Present value, right? Discounted back at your expected return. So that gives you the opportunity cost. So that delta between what would you have gained by paying the tax later versus what are you paying now? But it's not like you're paying taxes that you would have never paid. You're just paying taxes earlier than you would have otherwise by selling these securities now. So I think that just in evaluating what is the total tax cost, I think that's really important to think about. It's what am I paying today versus what is the present value of what I would have paid in tax in the future.
But certainly by diversifying, you're going to increase your reliability of outcomes, the expected outcome.
Absolutely.
And that's rational. Now, the irrational answer would be, but I love these stocks. And we all know a lot of people love individual stock choices they've had, especially with large gains.
For sure. But I love the data from this paper that just came out on do global stocks outperform treasury bills? And I think we've mentioned this data point a few times.
Sounds like our favorite data point. I love it.
So from 1990 to 2018, 1.3% of the stocks in the global market explained all of the wealth creation in excess of T-bills.
That's for 28 years, 1.3% of the stocks.
It's crazy. So over that same time period, 56% of U.S. stocks and 61% of non-U.S. stocks underperformed T-bills.
Gosh.
And then even with, say half of stocks underperformed T-bills, half outperformed T-bills, but to get the net gain, you had to have those 1.3%.
Right. Now an active manager would say, well, I just want to avoid those underperformers, those 56% underperformers. Okay. So I guess you could make the argument.
Good luck.
Yeah, exactly.
I wish you luck in your endeavors, active manager. Yeah. So you mentioned increasing the reliability of the outcome. And based on the data point that we just mentioned, I don't think that the reliability point can be overstated. Like if you hold say 50 stocks in your individual security portfolio, you've got a pretty good chance. I mean, in the study that we're talking about, there were 61,100 stocks in the study. If you're holding 50, the chances of your 50 being the 1.3% that drove the returns are pretty low.
The other thing I would look at too, which we've done for a lot of clients, is take a goals-based approach. So look at if you did sell and get a more diversified, more reliable portfolio instead of that single stock, is it a more reliable, will you have met your goals in that decision?
Right. When we're talking about reliability, one of the most interesting ways to think about it, I mean, all reliability means is decreasing the dispersion of outcomes. That's what we're talking about when we say that reliability. Vanguard did a paper in 2012. They were looking at active share, which is like when active managers are extremely active, they're like extremely different from the index in the portfolio that they're holding. Does that add value? So that's what they were looking at in this paper that I'm about to mention. But one of the things that they found is that the higher active share funds, they didn't necessarily do better. So this is like more concentrated funds that are extremely different from the index. They didn't necessarily do better they didn't do better on average, but they had a much wider dispersion of outcomes. It kind of related back to what you're saying, Cameron, about loving the stock. It's like you might own a stock that's done really well. And yes, that can happen. When you have a wide dispersion of outcomes, that dispersion can land on the plus or the minus
but
relative to...
you can have a good outcome from a less great decision.
Oh, that's absolutely true.
But then that skews your behavior because then it breeds overconfidence.
For sure. Dispersion can give you a good outcome. It doesn't mean that you made a good decision by having a concentrated portfolio. Anyway, my opinion on this is if you have this concentrated portfolio of individual stocks and you've made the decision to transition to index funds because you don't want to be an individual security investor, even if there's a big tax bill, in general, it's probably pretty sensible to at least over time shift toward index funds, if not ripping off the Band-Aid in a single year, depending on the tax situation.
So that would be our rational answer to that question.
Yeah.
Current topic number 1. So you picked off this story in The Economist last week, which kind of follows the Michael Burry question that is still coming up in your comments on your YouTube channel.
Yeah. Well, you hit the nail on the head last time we talked about this, is that people are saying like, oh, finally, I knew something was wrong with index funds. Like we got you now. It's exactly that.
Yep.
I do think it's interesting that Michael Burry has credibility because he shouldn't, but he does because he was in a movie, I think.
That might be a little edgy, but...
Is it?
Yeah, well, was it luck or was it skill?
Well, that's exactly right. I love what Barry Ritholtz said when he was on our podcast a while ago. He called the bottom of the crash, but he doesn't believe that he can do it again.
Yep. Didn't hurt his career though, did it?
No, it didn't hurt his career. So in this Economist article, they're talking about index ownership of the market, but they're also talking about quant ownership of the market. What really attracted me to the article is that they had a breakdown of asset ownership. So I just did a video on the Michael Burry thing, basically, on how much do index funds affect prices. And the data that I found was not as recent as this. So they had data from 2018 or even 19 for like ownership of assets. So they showed that the total U.S. market based on the Russell 3000 is about 31 trillion in market cap.
So that's 3,000 largest publicly traded companies in the U.S., which is the vast majority of the market cap.
Index funds, ETFs, and quant funds own about 35% of that. Traditional hedge funds and mutual funds own about 24%. And the remainder is held directly by companies, governments, insurance companies, and foreigners. So that 35% owned by index funds and quant funds is kind of the number that they're keying in on in the article.
So that's 31 trillion is largely the U.S. stock market. Of another chart that you found shows that the global value of stocks is around 75 trillion.
And we know from like the studies that I cited in my video on the index fund bubble idea, indexing in the US is way stronger than indexing globally.
Oh, by far.
So if we say the US market's 31 trillion, global market's 75 trillion, even if indexing is not 35% of the US market, indexing and quant and ETFs, whether they're indexed or not, make up 35% of the US market. And then relative to the global market of 75 trillion, that number is even smaller.
So this is ownership you're talking about. And regular listeners know a few weeks ago we talked about ownership does not translate into trading activity.
That's right.
Trading activity for index funds is way, way lower than the percentage of the market cap.
That's right. So anyway, this Economist article, opposite of Michael Burry, who was saying that this is causing the markets to be inefficient, the Economist article is actually saying this is mostly the quant ownership and is making the markets extremely efficient.
So quant basically means it being run by computers and algorithms as opposed to predictive models run and decided by humans.
That's right. And they're talking about machine learning and artificial intelligence. And they tried to draw an analogy and then they shut down their own analogy. But I'll talk about what I mean. They use chess And they talked about Google's AlphaZero, which, as I understand from the article, is a machine learning device that was given the rules of chess and then taught itself how to play.
Crazy.
It is crazy. But the interesting thing is that AlphaZero was able to beat Stockfish. Stockfish is another artificial intelligence machine, but instead of being fed the rules and teaching itself how to play, Stockfish was fed all of the possible moves by humans. So really smart humans told Stockfish how to play. AlphaZero was given the rules and taught itself how to play. And AlphaZero was able to beat Stockfish.
Wow.
It is cool. So in this article, they're talking about how that type of machine thinking, and they talk about factor investing quite a bit in this article, but they're suggesting that it's possible that a machine that does not think like a human and has none of the biases or preconceived notions that a human would might be able to find factors that a human never could.
Yep. And could learn to beat the human decided factors, even if it's being run in a quant type model.
Right. So then they quote Ray Dalio a few times in this article. And Dalio, I agree with what he says. He says chess has a fixed set of rules, but the stock market is a complex adaptive system. So machine learning, it doesn't help you in a complex adaptive system. What did Dalio say? He said, a machine learning strategy is bound to blow up eventually if it's not accompanied by deep understanding. And they also talked to Brian, well, they quoted, I don't know if they talked to him, a guy named Brian Kelly, who's at Yale, and he's also AQR's head of machine learning. He said that they have discovered machine-derived factors, like what we were talking about. So a machine that taught itself how to find factors and then found factors. And he said that even though they look good in the data, they've almost always been spurious.
Right. And this is what we've talked about at length, which is factors have to have some sort of reasonable, rational economic underpinning.
Yeah. So Brian Kelly, the AQR machine learning guy, said combining machine learning with economic theory works better, which is exactly what you just talked about.
Yep.
One of my favorite parts about this article was that they had Ray Dalio, who's being quoted extensively. Whenever I think about Ray Dalio, I can't remember where I saw it, and it's probably a well-known quote, but it was like, every success story should come with a disclaimer about survivorship bias. And whenever I think about Dalio, as smart as he is and as renowned as he is, it's like, you got to think about survivorship bias. And so in this story, they quote Dalio extensively as if he's like the ultimate source on whatever. And maybe he is.
Well, he runs the largest hedge fund in the world, right?
Yeah, which for sure gives him credibility. And he's seen some stuff. And he's smart. All more reasons to make him credible, even if it is luck. I'm not saying it is. So they had all these quotes from Dalio, but then they also, in the article, quote a guy named Philip Jabre, who I'd never heard of. And maybe I'd never heard of him because his fund didn't do well. So he launched Jabre Capital in 2007, and he's shutting the fund down now. But he's complaining in the article, saying that all these machines are making it impossible for humans to do a good job. But I just thought the contrast, it's like either end of survivorship bias. Dalio talking confidently about how to approach the market, and then this other guy saying...
But how do you blame the machines for causing you to do a bad job?
I don't know.
Okay.
Got to justify it somehow, I guess.
Next topic. So it's portfolio topic. I'm going to call it Risk 101.
Yeah, I thought it would be interesting to go through
some of the basics of the different types of risks that each and every one... I think we're going to get a chance here to reframe what risk is.
Yeah.
Because a lot of people, I think, just think that risk is losing all my money. Because when you dig in with people, portfolio going down, well, that's not really a risk. I'm worried about just complete capital vaporization, like the Bernie Madoff type scenario.
Yeah. And I think that we'll get into the planning topic after this, obviously, but the planning topic, we talk about annuities, which encompasses another type of risk, which is longevity. But other than that, when we're talking about investing, I think the big ones are total loss, like you were just saying, volatility, uncompensated risk, skewness, and inflation. So I thought it'd just be interesting to talk through each of those.
All right.
Total loss, like you said,
pretty obvious.
You can lose all your money if you buy one stock. That can happen. Nortel, you gave the example earlier. Total loss is pretty easy to diversify away. Like if you own a globally diversified portfolio of index funds, total loss starts to become...
Well, if there is total loss, you got much bigger problems than your portfolio.
Yeah. I mean, that's...
Even if you work for a government, because there's no tax revenue base to pay for your job. So you and I would go before the government workers, I guess, but...
Yeah, maybe not long before, though.
Maybe not long before, but...
If a globally... Like if a VT, like Vanguard Global Stock Index, if that goes to zero...
We're done.
That's... The current economic system is by definition... vaporized.
I'm not even sure this podcast would survive that.
I don't know about that.
Maybe all we have left to do is our little podcast.
Okay, so total loss, you can diversify that away.
Okay, so let's go to the next one, volatility, which is the variability of price.
I think volatility can be a risk, but it depends on the situation, like a real risk. Well, there are two situations where volatility is a real risk. One is when you need the money soon. So if you're investing in stocks and you need the money next week, there's a very good chance stocks are down next week. That's a real risk. And then the other time volatility is a real risk is behaviorally.
Exactly.
If you're throwing up because your portfolio is down 50%, that's a real risk. You don't want that.
Correct. You always have to know when you build a portfolio what the potential outcomes are so that you don't end up in over your head, and don't let recency drive that asset mix. You have to know what can happen.
But other than those two scenarios, so when you need the money soon, and if you're going to throw up when your portfolio is down 50% or feel sad or whatever, however you want to describe it, barring those two cases, I don't think volatility is a real risk.
Absolutely.
I think it's actually a really bad measure for risk. Fama and French did a paper last year called Volatility Lessons in the Financial Analyst's Journal. And they took a really interesting approach to thinking about volatility. They used historical stock market data to build a bootstrap model, and they ran 100,000 simulated time periods of various lengths to look at the impact of volatility on the outcome.
So cool.
It is so cool. So for the equity premium, so that's stocks outperforming risk-free assets.
T-bills.
T-bills, yeah. They found that over 1 year periods, so this is just relating that volatility back to being a real risk. Over 1 year periods, they found that there's a 36% chance, or in their simulated trials, there was a 36% chance of stocks making you worse off than investing in risk-free investments.
Isn't that amazing? A third of the time you're expected in stocks to be less in your portfolio a year from now than now. And so many people look to active managers to ensure that doesn't happen.
Yeah.
Isn't it liberating? I mean, you think back to Dave Gatch, right? If you know this going in, so it's down in a year.
It is what it is.
So it's not unexpected.
But that's the thing, is that it ties it back to when is volatility a real risk? Maybe when you don't expect it, maybe it's a real risk.
So go to the longer time period.
Yeah, so I'll just mention that 36% in the simulated trials is about the same as what we've actually seen historically, which is just an interesting point. But Fama and French, what their paper did that was really interesting is that because they were doing bootstrap simulation, they were able to look at 100,000 30-year simulated periods. We don't have 100,000 real 30-year historical periods to look at. So they found even over that longer time frame, there's still a 4.08% chance of a negative equity premium.
So it's still giving a positive return depending on what the risk-free is. So it's the delta to the risk-free rate.
Right. But the point is, in 4.08% of cases, you would have been better off not taking any risk.
Yeah, you can hear, I should have invested in GICs the past 30 years. Yes, there is a chance of that. Yeah. Otherwise, it would not be a risk premium.
Yeah. But it is crazy to think about. Now, in the Fama French paper, they also looked at the value premium and the small value premium. So stocks underperforming risk-free assets, 4.08% chance. A negative premium for the market-wide value, so value stocks across the market. Over the market, there was a 0.96% chance of underperformance over 30 years in the bootstrap. And with small value stocks, it was a 0.17% chance of underperformance over 30 years. So
which is less than the market.
Yeah. Okay, exactly.
So how can you ignore those factors in a portfolio?
Yeah, I know. Well, that's the whole point about factor diversification. But this long-term data on the chance of a negative premium is just another interesting perspective to think about that. So I think what we can take away from that, though, is that volatility, even over the long term, even if it is less of a risk, but even over the long term, there is a chance that volatility results in a negative risk premium.
For sure.
But over longer periods of time, the chance of that happening is much less. And adding in additional risks, like we always talk about, decreases that chance, which is just classic diversification. One thing that the Fama French paper intentionally leaves out, because they believe it always should be left out, is any autocorrelation in stock returns. So because they use bootstrap, any relationship between yesterday's return and today's return is eliminated by nature of the way that they're simulating the return periods. In real life, there's some evidence of autocorrelation, so some evidence of like mean reversion.
And we've talked about that in the past too.
But it's probably not reliable enough we talked about the safe savings rate a while ago, which we thought was pretty cool, but then we kind of realized that you can't really rely on past mean reversion to repeat. So anyway, just an interesting note that in the Fama French long-term 30-year, there's a chance of negative returns. Historically, that's been less true because of mean reversion, but we can't really bet on mean reversion repeating itself.
All right, let's keep rolling on to the next risks here. Uncompensated risk, which is a different type of risk. So this is the risk specific to an individual company or sector or country. So you don't get a higher expected return for having that concentrated, call it a bet.
It's like the difference between loading up on small cap value over the entire market, you have a higher expected return. Loading up on technology stocks, you don't have a higher expected return. You're taking on uncompensated risk. You may get a good outcome, you may not, but there's no reason to expect that you will.
And if you can't live with that downside, rational person said you wouldn't go for the upside. Like if it starts to blow up your plan because of some unexpected downside, and we've seen both. We've seen lots of great upside, but we've also seen catastrophic downside too over the years.
For sure. Uncompensated risk, I mean, it's a choice at the end of the day. Like, and it also, somebody actually asked me a question again by email that was really interesting, and asking if you're introducing any uncompensated risk by adding in factors. Like the knee-jerk reaction is no, you're not. But I started thinking more about it, and whether you're adding uncompensated risk or not depends on the model of market equilibrium that you're using to think about risk.
Okay, everyone's collectively scratching their heads. What did he just say? Let's rewind the tape here.
So it's like if you're using the Fama French 5-factor model as your market of model equilibrium. So the model of equilibrium means how does the market price assets in a normal state? So if the market is efficient, what risks are being priced into stock prices? So under the Fama French 5-factor model, we know what they are. It's market size, value, profitability, and investment. So if you're looking at the market from that perspective and you add in additional small cap stocks, that's not adding in uncompensated risk. It's adding in priced risk. But if you choose to use a different factor model to look at the market, like the MSCI has a whole different set of factors that they've developed. I think they're silly. But if you look at the market from the perspective of that being market equilibrium, then maybe adding in profitability, whereas MSCI defines that sort of type of factor as quality, and it's a different metric. So if you load up on highly profitable stocks, when the MSCI model is saying quality is the priced risk, then you are adding some uncompensated risk.
A little technical, but I agree with you. But for the average investor, uncompensated risk would be largely single security risk.
Single security risk. I think single sector risk is a big one too. Like I know a lot of people that go all in on tech or something like that. Or going all in on REITs, which we talked about in a previous episode.
But the big risk to all of this is the follow-on risk. You get it right, leads to overconfidence, which leads you to making further bets, and these bets taking up a larger part of your portfolio going.
And not understanding why you got that outcome. You get a good outcome from uncompensated risk. Why did that happen?
Let's get back to, who was it talked about in one of Shane Parrish's interviews, talking about the decision log or decision journal.
Decision journal, yeah.
Write down, if you did write down for every stock choice you made, what are the reasons why? Go and see how the movie plays out and see if it was your reasons that explain what happened. I know it would be laborious to do. It's probably theoretical, but reasons change depending on how the outcome goes.
But it comes back to theory, right? It's like you might get it right for the reasons that you thought were the right reasons, but if those reasons, if they don't have theoretical basis, then how can you say that it was the right decision? You can't really. But most people don't have that theoretical framework.
Two more risks, skewness.
So it's kind of like uncompensated risk in a way. They're definitely related, but we already talked about the data on the 1.3% of stocks driving the market's returns. And we've always known stock returns had a big positive skew. That paper to global stocks outperform U.S. Treasury bills really defined how extreme that skew is. But it's basically like in stocks, you've got more negative returns than positive returns, but the far right tail of the positive returns are extreme enough that the average, well, it's the skew. You don't have a normal distribution. You have more negative outcomes, less positive outcomes, but the positive outcomes are more extreme.
Causes a skew in the curve.
Causes a skew in the curve. All of the risks that we've talked about so far, except for volatility, but total loss, uncompensated risk, skewness, those can all be addressed with proper diversification.
Correct.
Like that's easy.
And the last risk is inflation, which is the one risk as to why you're taking on all these other risks to try to beat inflation. And I mean, one of the best stories I ever saw in inflation, and I know we have a lot of advisors that listen to this, maybe before your time, but Nick Murray, who's a consultant in our industry, used to hold up a card showing a postage stamp. I haven't bought a stamp in probably 5 years now, so I have no idea how much they even are now. But he held up this thing showing stamps way back when were 4 cents, and now they're whatever it was, 50 or 60 cents for a stamp, saying that's your perfect illustration that everyone can relate to of inflation.
Yeah, it's interesting.
That's the big risk. A lot of people would say there's no risk in holding bonds, but the reality is bonds are the poorest at beating inflation.
Well, it's the thing you said when we started this segment was we were going to reframe how to think about risk, and that this is a big piece of that. So I think to think about risk, we have to think about why are we investing in the first place? And for most people, it's to facilitate future consumption. You're investing today so you can spend money in the future, and the money will grow sufficiently to cover your future consumption needs. But from that perspective, like all the risks we've talked about so far, total loss, easy, diversification, volatility, not really a risk.
But you have to learn how to embrace it.
Yep. Uncompensated risk, diversify it away. Skewness, diversify it away. Inflation, though, the best way to battle inflation is stocks. Stocks aren't necessarily an inflation hedge in the sense that when inflation is high, stock returns aren't necessarily going to be high. But over the long term, the equity premium should be sufficient to beat inflation. It's harder to say the same thing with bonds. So I actually think for a long-term investor, and this is something that I talk about with clients fairly often, I think that for a long-term investor, there's a pretty strong argument to make that bonds are substantially riskier than stocks.
In general or now specific?
Not now specific, in general. Your chances of being unable to meet your future consumption needs by investing in bonds are much greater than investing in stocks because of the higher expected returns of stocks.
But you make a case that's even more so now because we've gone through a generation of interest rates falling, which skews past returns on bonds.
Very true.
Interest rates fall, bond prices rise. We've had great returns on bonds over the past 30 years.
We've also had low inflation.
Right.
So I think that thinking about risk from the perspective of future consumption for an investor who has a long time horizon and a stable income and is comfortable with volatility, I think there's a really strong argument that one of the biggest risks out there is having a portfolio that is too conservative for the wrong reasons.
Right.
If you view volatility as a risk, like an actual risk, then you might have a more conservative portfolio. But if you understand that volatility is not a risk and future consumption is a risk, then your safe feeling portfolio, like, your 60-40 portfolio when you're young, I think there's a pretty good argument that is riskier than being 100% in stocks.
But if we go back to Larry Swedrow's framework, which is the amount of risk you take on is your ability, willingness, and need to take on risk. If someone has a very low willingness, just know that ahead of time that you are a 80% bond, 20% stock kind of investor, but make sure you do your planning appropriately so you know you're saving enough. Like that's
fair.
a preference.
That's fair.
Right?
That's fair.
We have some clients that don't want any equity exposure, but they've done their planning appropriately.
It's just that conversation about what is risk. Like when you say,
totally.
I'm risk averse, so I want to be an 80-20 investor. What risk are you averse to?
Right.
Are you averse to volatility? Because that's not really a risk, and maybe that's a conversation.
The ones I'm thinking of, they're averse to just when markets do bounce around, they just don't like that stress in their lives.
Volatility, for sure. Behaviorally, that can be a real risk. And we chatted about that. I think that whole discussion about what is risk over the long term is an important one to have.
Okay, so let's move on to the planning topic of the week, which is annuities. This goes back to, stimulated, I think, by our conversation with Alexandra McQueen, whatever it was, 3 weeks or 5 weeks ago, which was a fabulous interview. If you haven't listened to it, go back and check that one out. And she talked to us about product allocation, specifically about how annuities might fit into a retirement portfolio. And the amazing thing about annuities is that one is it protects you against the risk of living a long time, so longevity risk.
It's insurance. It's longevity insurance.
Yep.
If you live to be 115, but you plan to live to be 95, then that's a substantial risk.
So the example I heard on that, I don't know if I mentioned this 2 weeks ago on the podcast or not, but I think it's something that Alexandra retweeted, which was, for this example, someone had a 6% chance of living beyond 95. And I know anecdotally, most people say, I'll never live to 95. I'm not worried about it. Yeah, but if I told you that flight you're about to take had a 6% chance of crashing, would you be taking that flight? So same question, effectively. If there's a 6% chance, why would you not plan accordingly around that?
Yeah. And longevity it's something that's really tricky to protect against as an individual because you have one lifespan and one pool of assets.
Right.
And if you die, that's it. If you live long, that's it again. Your money might run out. But as soon as you buy an annuity, you're entering this pool of other people who are going to fall on different places of the distribution of outcomes in terms of life expectancy. So it's like people that die early end up funding the people who live long. And that mortality pooling is one of the biggest benefits of entering into an annuity contract. So longevity protection is huge. And then the other one is sequence of returns, which we can kind of tie back to our conversation about volatility just now. It's like over that 30-year period, you can still have a negative outcome, and that's due to sequence of returns, having a bunch of bad outcomes in a row. Annuities.
And early in your retirement.
That too, yeah.
If you have bad sequence and early, that can hurt.
So annuities address this because you don't have volatility. I mean, you get it with an annuity, you get a guaranteed income as long as the insurance company remains solvent, which they've been pretty good at doing over the long term.
So since that call, you guys got a hold of some software, right? That I know Professor Moja worked on. I think Alexander was involved as well, right?
Yeah.
So he's a finance prof at Schulich School of Business at York University.
And he's written a massive amount of academic papers on product allocation and using annuities for optimal retirement outcomes.
He's certainly, I think, one of the leaders in the world on this topic.
Yeah. He's up there, and it's neat that he's Canadian. So they built this tool called PRARI. It's a terrible acronym, but it's a PRARI. It's a product allocation optimization tool that uses stochastic modeling based on Milewski's work. But the best way to describe it is that we know like an efficient frontier for portfolios. I think most people are familiar with that idea.
Highest return per unit of risk.
That's right. So the PRARI tool spits out a sort of an efficient frontier of product allocation.
So this would be the mix between a long-term portfolio and annuities.
Yeah.
And certain things will skew that decision, like how much pension you have, how much assets you have.
Yeah.
Those would be the two big ones, I think, right?
Yeah. How much you're spending, another big one. The PRARI tool takes the probability distribution of life expectancy into account. So the input of life expectancy actually is not a consideration in the tool because they're modeling the variability of that. So we've been using this PRARI tool just kind of as a pilot study to look at actual client situations and see where there might be cases where it could be useful. And our sample set is probably not ideal in general, although we're going to think about it a different way, which I'll talk about in a second. But as a generalization, annuities are really nice in terms of being optimal when you're in a situation that you don't quite have enough money to achieve your goal.
But it's like almost the ultimate rational decision to be made because you're taking all biases about where the market's going to go off the table, how long you're going to live off the table, and saying, okay, computer model, go and tell me what the best product mix is.
Yes.
Because when it comes time, as we said, to do an annuity, it is hard to let go of the check as your money is gone.
And it's because you don't know where you're going to land on that probability distribution of life expectancy outcomes.
But it's where you've got emotions on one side, and you wanting to maximize utility, maximize consumption, but there is a 6% chance or whatever that you live a long, long time. Rational person would say, I have to protect myself against that.
But the fascinating thing is even without that, even if you don't land on that long tail on that side, on average, statistically, allocating some portion to an annuity as a retiree is optimal. The risk is you land on that shorter side of the distribution. You die early and you end up with less because all the annuity money goes away. Anyway, so...
Which is why it works.
Right. So I said that our clients aren't ideal in most cases because they're not in a situation where they don't quite have enough to meet their goal. When you're talking about annuities, you use the RSQ, which stands for the sustainability quotient, like how likely are you to run out of money? And for an annuity to make a lot of sense, you want to be sort of at the 75% chance of ruin, 75% sustainability quotient. And adding in annuities might push you up to 85 or 90%. In most cases, people are at, like they've got more capital than they're ever going to need, which makes annuities a little bit less obvious in most cases. But as we've been looking at these optimizations, one of the things that I've started thinking about is that if you bucket off the amount of capital that you need to fund your future consumption, adding in annuities can still make that bucket optimal. So if we took the amount of capital that it would be such that they had a 75% sustainability quotient, we could then allocate annuities within that to make the sustainability quotient higher.
So you have a second bucket that's excess capital.
And exactly. So you can build a bucket of retirement sustainability that's an allocation of annuities and financial market investments. And that becomes the retirement bucket. So it's kind of like we're creating a situation where the annuity does make sense.
So you have a safer retirement bucket with excess capital in a second bucket.
Exactly. And then your second bucket with the excess capital, you can start thinking about taking more risk if you want to.
That's your small cap value portfolio.
You can also start thinking about gifting while you're still alive to kids or to charities and stuff like that. So as much as I said that our clients aren't generally optimal, I think that there still is an interesting argument to be made in terms of optimizing for efficiency on the retirement bucket and completely separating that out from the, whatever you want to call it, legacy bucket maybe. So anyway, there was an example that I pulled just to talk through some of the numbers. If we take a 63-year-old who's planning to retire at 67 and they've got $1.25 million in savings and they're expecting $30,000 in CPP and OAS starting at age 67. So they're 63 now, retiring at 67, $30,000 in CPP and OAS. They want to spend $80,000 and their assumed inflation rate is 4%, which is not typical. We use 1.6% at the moment. But anyway, this example used 4%. Plus an additional $10,000 per year for the first 5 years for maybe travel.
And they have no goal to leave a large estate, but the goal is to maximize sustainability.
With a relatively small target legacy of $250,000.
So the goals are important to maximize sustainability.
Oh, it's super important. So base case with a 60-40 portfolio.
No annuities.
No annuities. This situation has an 82% RSQ and a $292,000 expected legacy. So in terms of RSQ, we want it to be higher than 82%. I mean, it's like your airplane example. Would you get on an airplane with an 18% chance of crashing? Absolutely not. So putting this information into the Prairie tool, it spits out the efficient frontier of product allocations, but I pulled the one that I thought was most compelling. So they just said allocating 15% to an immediate annuity and increasing the portfolio equity allocation to 80%. So doing those two changes, allocating.
This is on current pricing of annuities, obviously.
This was actually from a white paper from Canex. So it would have been pricing at that time.
So 15% goes to an immediate annuity. Yep. And then you're increasing the asset mix from 60-40 to 80-20 on the amount that's left over, the other 85%.
So the sustainability goes from 82% to 89%.
It's wild, eh?
Reasonably big jump. But the craziest part is you assume allocating to annuities that you're going to have less capital left over. But because of the increase in equity exposure, the expected legacy actually increased in the example from $292,000 to $351,000. So you're getting higher sustainability quotient and a higher expected legacy, which is why Milewski's so fired up about this whole concept. And it's the whole argument about efficiency.
That's the argument right there in one paragraph.
So looking at this overall, if you think about the annuities as fixed income, you do end up with a slightly more aggressive portfolio. Like it's I think it was 68% equity. But I think there's also a pretty good argument that the annuities are safer than bonds. So you do end up with a bit more equity exposure, but you also end up with a safer, more guaranteed fixed income component.
Super cool.
So anyway, that was just one little case that I pulled out of a white paper they'd done. It mirrored the cases that we've been looking at in real life. So anyway, this is an ongoing area of research for us, but it's as compelling as Alexander made it sound.
Totally agree. Okay, let's go on to the last topic, last week's worst advice. So this one's gotten a ton of press conference coverage and media coverage and Twitter coverage, the whole thing about free trading in the US. So Schwab went first, and they dropped their trade fees down to from $4.95 a trade on a stock ETF or an option trade down to $0, and then quickly TD Ameritrade and I think others in the industry. So basically, trading for individuals, the cost is now gone.
You pulled some great stats from an article that you found. So for Schwab, their trade revenue was 3 to 4% of revenue.
Yeah.
Relatively small drop in the bucket.
Well, still $100 million a quarter.
That's it. Okay.
But they have AUM of assets under management of $3.7 trillion at Schwab. So, I mean, that's a big number per quarter, but yeah, it's not a huge percentage of their revenue, but still that revenue is gone. And I would argue $4.95 really going to $0? Like, is this really a good thing? Do you really care about $5 a trade?
People do care about it, but I don't know if it incentivizes the right behavior because now people feel more comfortable trading. And we know people from past studies that we've looked at, people generally take bets that are too risky and they generally overtrade in their individual brokerage accounts.
I got a total kick out of the TD Ameritrade quotes that came out after they dropped their fees. They oversee $1.3 trillion. So TD Ameritrade is a huge online broker in the US. Quote is, "We firmly believe that investing is a pathway to a better life and are fully committed to providing more people with the access, education, and help they need to confidently navigate and build a more sustainable financial future for themselves and their families." Beautiful. But dropping your trade fee is going to do that. And there's no link between lower fees and more trading activity. And the evidence on online trading is terrible. But next quote, "The company has been building up its investor education offerings in the past year," she said, adding, "relevant information delivered when our clients could best use it and in the formats they prefer, increases confidence and empowers rational decision-making."
All depends on your definition of rationality, I guess. If trading stocks because of a Trump tweet is rational, then maybe they're doing a great job.
So the question is, these firms are public. They got to make their money. I think everyone knows they're going to make it somewhere. So the question is, how will firms make up this lost revenue? Like nothing is for free.
Well, I mean, the answer is somewhere. And that's all that matters.
The answer is somewhere. So I was at a conference this week and we were talking about this. And they said, well, it's all, this person said it's all in the cash. Where's the cash? So I dug up an article that Jason Zweig wrote in the Wall Street Journal March of last year, and he had done some research. Things may have changed, but the point is that there is return to be made on cash balances, which in the online world are historically known to be high. A lot online traders leave a lot of cash in their portfolios.
Leave cash in the portfolios. But the point of the article is that the brokers that are charging no fees are paying tiny interest rates on cash balances.
Yeah, they do what's called sweeping. So a bunch of firms swept money from money market funds, which is where you're invested in a money market fund or a product with another company inside that brokerage. So we do this all the time with high interest savings accounts, which are issued by a number of different firms inside the portfolios here. So there's no large cash available for the brokers to make the spread on. But there's some huge numbers.
So sorry, when you're saying they did a sweep, they took the money out of money market and put it into cash balances?
It was a mandatory sweep. Yes, that's what the article is about, sweeping, highlighting how firms swept billions of dollars from money market funds into, quote, lower yielding bank sweeps.
So the answer is, where's the revenue coming from? They're earning spreads on cash balances. And then the other one, and not necessarily about these guys, and I doubt that they're doing this, but Robinhood, which is the one that's made lots of noise about free trading in the US, and they're arguably the ones that drove this whole change. They're making money through order routing. So they're sending all of their trades through high frequency traders, which they're, again, getting comped on. But then you're not necessarily getting the best execution as the person placing the free, in quotation marks, trade.
But guess some of these numbers from this article. This goes back, it's Jason Zweig's article from a year and a half or so ago. So Ameriprise Financial had $24 billion in cash. And Ameriprise makes 10 times more than customers on the cash balances. E-Trade had $38 billion. E-Trade paid 0.1% yield to clients in the prior year. 25%, get this, of LPL, which is a big financial enterprise in the US, 25% of LPL's gross profit in a recent quarter was from cash sweeps and was almost as much as LPL's commission and advisory fee combined.
Crazy.
It's like Costco. Costco makes all their money off the membership cards and give the product at cost, basically. Like that's what's going on here. Raymond James had $41 billion in cash sweeps.
Yeah, I mean, nothing's free. Nothing's free. And, free trading is probably not a good thing anyway because people overtrade. You pulled the chart, I don't know where it's from, but the data...
Morningstar.
Okay, it's from Morningstar, showing the average holding period for a bunch of different ETFs. But just I'll highlight a couple because...
This is current. This is to the end of September 2019, the last 12 months.
So SPY, the Spider S&P 500 ETF, average holding period, 15.6 days.
This is the $262 billion ETF.
Crazy. I did think that the one for VTI was interesting. So Vanguard Total Stock Market, almost a year average holding period, 329 days.
Yeah, it's a big fund as well, 109 billion.
Anyway, point is, people overtrade. Free trades probably don't help that. And free trades probably aren't free anyway.
Nothing's for free. Anything else?
That's it.
It's a good episode, a little bit long. We apologize, but I think there's a lot of good information, and thanks for listening.